This is Dr. Craig Lemoine, the Director of the Undergraduate Financial Planning Program at the University of Illinois. Today we're going to dig into unemployment insurance, a very important topic in spring of 2020. In the last 2 weeks, we've seen over 10 million Americans lose their job. And after a 9-year bull market, this is unprecedented in the history of our country. 3 million Americans losing their jobs in the last week of March, another 6 million losing their jobs in the first week of April. This type of job loss is tied to the economic environment and shutdown that a virus has caused, but it really ripples through the economy, and it's very important to understand what's going on and what we can do about it as consumers and financial advisors. Estimates for total unemployment in March were that our country may wind up seeing 20 to 35% unemployment. Now, let's hope that doesn't come to pass, but I really love this chart because it shows historical United States unemployment rates. And when we look at the very peak of the most recent 2008-2009 recession, what we see is that unemployment spiked out at just over 10%. We're already well on track for 10%. By next week, we will likely hit 10% of Americans being unemployed, if not the week after. And considering that the trend of stay at home is sort of gaining momentum and steam, we're seeing more and more folks out of business, out of service, and unemployed. If we do have a 20 to 30% unemployment rate, just look at that in scale compared to history. We'd be looking at more unemployment than we've seen even considering the Great Depression. So this unemployment rate is just an unprecedented reality that we've all jumped into. And starting at the beginning of the year, I don't think any of us saw this coming, that this unemployment would be so gripping to our country. This graph just kind of helps show, it's a New York Times graph, but it kind of gets the point across that here's the average weekly new claims that we see. And in the last week in March, you saw about 3 million claims. That was staggering to our economy. We said no one had ever seen anything like it. And now here we are a week later with 6 million claims. I mean, what does 2 weeks from now hold? 12 million, another 6, and no one really knows. But we're just starting to see as a shutdown in services, a shutdown in travel, a shutdown in dining, and then the repercussions and ripple effect that has through our economy. It's also important to note the employees who are filing unemployment for the first time. Generally speaking, most of these employees would make under $800 per week to begin with. And so we're really starting to see some financial uncertainty and really troubling times. Now, we have some stimulus coming, and the focus of this talk isn't necessarily on stimulus checks, but we do have some assistance coming this way, and we're also going to have some state and CARES unemployment benefits. But, we do need to talk a little bit about the first bit of stimulus coming, and that's in the next 3 weeks from the first week of April. So at some point in the month of April, we should see $1,200 checks for most Americans, $500 for most children, of that group that is impacted. Of the 9 million Americans who've lost jobs, we should get some short-term relief relatively quickly, and possibly quicker than seeing unemployment issues resolved and unemployment insurance issues paid. But the highest end would be married with 2 or more children. We're looking at a $3,500 check, and then it scales down from there, married with 1 kiddo, married with no children, and then we also have some special categories, head of household as well, for a single filer. It's important to note with the CARES Act, it is somewhat income sensitive, and so at this sort of $75,000 level, for a single individual with no kids, we're going to start phasing it out up to about $98,000. What we're looking at is this is a 2020 tax credit. And so we're going to look at your 2018 tax return, assuming that you filed one. If you qualify, we'll go ahead and generate that check. If you didn't qualify, we'll look at 2019. If you filed a return, if you didn't qualify, we'll look at 2020. So there's really 3 shots at getting this tax credit. You will need to file a tax return, although we did learn on April 1st, April 2nd, that some Social Security filers will go ahead and get this, even if their income may be such that they don't tend to file regularly. But the purpose of this talk is more about unemployment insurance, so we're going to move on into that area. One of the issues with the unemployment insurance, we're going to learn a little bit about the state system and then federal subsidies that have been applied. The big federal subsidy, the big takeaway is that under the CARES Act, federally, we're going to enhance state unemployment benefits by $600 a week for up to 39 weeks. And the fear that I have from a professor's seat when I look at this is we already have 10 million people that are going to trigger and qualify for this benefit. So 10 million people times $600 a week by 39 weeks, you're looking at $234 billion. And team, we are just getting started. When this number crosses 20 million, if this number crosses 30 million, if this number gets to 50 million, you may be looking at $1 trillion or more dollars just in this benefit that's going to be rolled out. Now, that is substantially more than was budgeted in the CARES Act. And I think it's something to consider, maybe even an earlier second stimulus package to say, hey, you know, what's going on here? Now, this flow chart is very, very important because what we're saying is, hey, what if I'm already receiving unemployment benefits, right? What if I'm sort of the million people that were already in this process before the CARES Act went into place? You will be receiving the extra 600. You don't need to do anything. And when those paychecks are processed in the next week or two, that extra 600 will flow in. If you're eligible, and we'll talk about eligibility here coming up, you'll apply. And if you're approved, then you'll get the state benefit plus 600. There are certain other folks we'll get into in today's lecture that traditionally would not be eligible, but under the CARES Act are now going to be. And we'll talk about that group here later on. So what we really have is a unique system that's been put in place where we've extended state benefits. It's already cost in the billions of dollars, and it's not going to be any cheaper from here. So my big worry on this slide is that we've estimated certain unemployment rates in the CARES Act, and I think we could very, very easily exceed those rates to the tune of $1 trillion of this unemployment stipend. Are we ready to do that as a country? Do we have the money set aside? Those are questions we're going to have to answer in the next month or two. This slide does a fantastic job of showing the US unemployment rate going back to the Great Depression. And it also shows inflation, which is part of the puzzle and part of my worry when we have this kind of ultra unemployment world. That unemployment tends to be a leading indicator of what is to come. So when you have a higher unemployment rate, generally speaking, that sets the economy up to be less productive with a little less GDP. And then as that unemployment goes down, the economy tends to pick up. Now, inflation tends to be a lagging indicator. And you can see that here, right? Unemployment goes down and inflation goes up. The worry then in the short term is that high unemployment can often lead to deflation, right? As the higher the unemployment gets, you can start to see cost of goods and services getting cheaper. The dollar goes a little further, and you may think that's a good thing. But when we look over time at costs going lower, 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 that can actually be very negative and harmful to the economy. It can be very harmful to manufacturers, and it can actually lead to more unemployment as sort of as a cyclical process. So we need to keep an eye on inflation. Yes, we like cheaper gas. Yes, we like cheaper groceries. But let's just kind of keep an eye on that over time. And as unemployment might spike, we may see inflation take a nosedive. And those two things together can be a really nasty cycle. We need to talk a little bit about who is getting laid off. If we're looking at stage 1 pandemic layoffs, right, now we're just kind of assuming, let's say we can keep this in a bubble, then who's going to lose their jobs? All right. The very first group of folks, Vox Media does a fantastic job covering this in an article. The very first group of folks are those sort of in the service sector, right? Front end, back end, restaurant, food. We're looking at over 10 million Americans there. And I know that what we have is more and more restaurants closing, furloughing, and all right, come back in May, come back in June, come back in July. But that does mean you're going to have a lot of population, folks that made under $800 a week to begin with, that lose their jobs. And in a minute, we'll see why that's so painful. Clothing and retail stores, right? In early April 2020, Macy's said, you know what? We're going to furlough 150,000 people. And that they may not come back, right? So that's another big group of our economy. And overwhelmingly, clothing and retail again, are in that under $800 a week category. I'll share why that matters here in a moment. We have support services, education. We've got, luckily the airline industry seems to, those that take the bailout do have a lot of requirements to keep paying wages, education as well. But I'll tell you what, come the end of the semester, come the end of May, if students aren't coming back to school, we're going to see absolute chaos in that world. Sports and entertainment as well is taking a big hit, in real estate. And what you start seeing are the workers in these areas, and I'm not even including the gig economy folks, the Uber drivers, the DoorDash folks, the Grubhub folks. And as less and less of that becomes available, what you start to see happen is more and more gig sector employees having a hard time finding work. So you have, if we can contain it to a bubble, pandemic, immediate impact, and layoffs. If we can't contain it to a bubble, every sector will start to be impacted, and this thing could ripple very fast unemployment-wise. So fundamentally then, what is unemployment risk? Unemployment is a human capital risk, and that is a risk to the present value of your future earnings, right? We become educated. We go to high school, perhaps we go to college, perhaps we get a graduate degree, and we're investing in ourselves. Maybe we get certificates, certification, learn technological skills, and all that is the idea of taking human capital and trying to maximize our lifestyle and the present value of our future income. So unemployment is a human capital risk. It's a lot like life insurance or disability, and the fact that if I die or I'm disabled, my human capital is eliminated or reduced. Well, same with unemployment risk, right? If my sector suddenly goes from 11 million employees to 500,000 employees, that human capital has been decimated. But unlike life or disability insurance, unemployment is more wicked because it is a systematic risk to the economy. It impacts the entire economy at once. It has immediate financial implications, the entire sector wiped out. It doesn't matter if you were the best cook in town, it doesn't matter if you're the worst cook in town, now you don't have a job. Unemployment risk also has big mental health risks. A lot of depression, a lot of mental health crises accompany unemployment. We feel like a failure. What did I do wrong? We didn't do anything wrong, right? The economy changed around you, and unemployment is a byproduct of that. In 2017, a Career Builder survey found that 78% of Americans responded, yes, I live paycheck to paycheck. That number was 90% for Americans making under $100,000. Now let's pause for just a minute and take that in. 9 out of 10 Americans report living paycheck to paycheck that live under $100,000, and everybody on this slide, almost every group, is under $100,000 of income. So this phase 1 pandemic is going to impact people that 9 out of 10 live paycheck to paycheck. Let's think that through. 10 million Americans unemployed, 90% of them or more live paycheck to paycheck. The realities and the ripples from that are horrifying to really think about. That means 10 million people going, okay, well, I need my next paycheck for rent and food. What do I do now? All right, and that's the scary part of this problem, is that less than a third of Americans in the survey could save more than $100 a month in their non-retirement savings. And so what that puts forward is, well, what am I going to do? How am I going to get through this? And so one of the backdrops that we have in this world is unemployment insurance. And traditional unemployment insurance isn't going to get the job done here. Traditional unemployment insurance is comprised of 50 state-administered programs. Every state is a little different than the other. Unemployment insurance is not paid for by employees. It's paid for by employers, which sets the first fork in the road, or I would say, big bag of sticks in the road, as we deal with traditional unemployment systems being unable to handle the situation. Traditional unemployment systems are paid by employers, but sometimes states allow certain nonprofits and religious groups to not have to pay in. So small churches, let's say, may be exempt under state law. Well, if the small church didn't pay in, and then you get laid off because we don't have congregations meeting and no one's putting money in the offering plate, guess what? You might get laid off, but you're not covered because your employer never paid in. Small businesses, typically, if they're small enough, the state may exempt them. Gig economy drivers, people that work for themselves, they've never paid in any premiums. And if you haven't paid in premiums, you're ineligible to collect. And employees often do not know this. And this is the first big failing of unemployment insurance and a type of systematic risk system that we're in when 9 out of 10 people live paycheck to paycheck. That a big percentage of those don't understand they're not covered by employment to begin with. Third off, one of the problems with unemployment insurance in a 50 state process is benefits are calculated differently in every state. They're capped and limited differently in every state as well. Illinois cap is twice the Alabama cap. So if I'm systematically unemployed in Mobile or I'm systematically unemployed in Chicago, I'm going to have two completely different elements there. And yes, cost of living does play in, but not 2 times as much, right? So that's really sort of flaws in how the current system is structured and unable to handle what's about to happen. So what's my easiest protection? My easiest unemployment protection, but is often unattainable, is cash. Do I have cash savings to get me through the hard time? The overwhelming majority of Americans, no, they don't have cash. Well, the next would be my non-retirement savings. We don't want to raid our nest egg if at all possible. Our nest egg needs to be there when we're older. Do we have that? And again, we saw only 33% were able to save $100, and so no. And then lastly, unemployment insurance. Can we count on our state unemployment insurance? And we say, well, that's also a no. We can't always count on that. There's caps, there's limitations and exclusions that don't lend themselves to 10, 20, 30, 40 million people needing these systems, much less the infrastructure even to sign up, right? To sign up for the state system may require you going back to their website 10 to 20 times a day just to be able to log in because the overwhelming volume of other people filing. So what are the core concepts behind unemployment insurance? We'll kind of understand these before we get to federally what we're trying to do. Number one, unemployment insurance encourages us to go back to work. So there's a tension point with unemployment insurance. Yes, the state wants to make sure you can feed your family, but at the same time, the state wants you to go back for work. Now, the problem with this first core concept is you may be the best cook in town. There are no restaurants hiring. You may be the best server in town and there are no restaurants hiring. You may be the very best hotel manager in town and there are no hotels hiring. In fact, they're shutting down one after another. So first off, it's a little flawed in the idea that I'm going to go back to work. Well, I mean, not for the next 2 months, you're not. So that's number one. That's the core tension point. And so we limit benefits to 26 weeks for this reason. State unemployment programs, 26 weeks, and by then we kind of say, okay, you need to get back to work. Number two, we require you to look for work, document you're looking for work, register and report you're looking for work. And so that's the core concepts, that it's a safety net, but the tension point is going back to work. And so how do we decide how much you get? We look back at your last base period in Illinois at 6 months, in some states it's 12 months, and we try to calculate how much you made during that base period, and then we base your unemployment on that. So a higher income individual might receive higher benefits, but we're going to cap benefits regardless. So am I eligible? Well, this is a state-by-state issue, but I'm going to give some general concepts here. Each state requires that your employer paid in. And so right off the bat, if you're a gig economy person, if you worked as a contractor, you probably aren't traditionally eligible. If you worked for a religious organization, you may or may not be. You really need to check into that. The second concept is that this is a protection of risk, right? So you shouldn't be able to trigger it intentionally any more than fire insurance pays if you burn your house down. So you're eligible if you're laid off by your employer. If you're fired for cause, stealing, embezzling, something like that, or you voluntarily left, you are not eligible for unemployment insurance. You have to have been laid off or terminated by the employer. Now, you can quit, but you have to prove harassment and discrimination. That can be particularly hard to do in a world with limited courts and limited adjudication right now when everything's sort of shutting down. Third off, there is a tension between employers and employees. An employer's premium is based on experience. What that means is it's based on how often they lay off an employee. So the more layoffs, the higher the premiums. A company that maybe has warehouses that are unattractive to work in and has very high expectations is going to have more laid off employees than maybe a law firm that's been open for 30 years. So the more people you lay off, the higher premiums you pay. And so sometimes what you'll see employers do, they don't lay you off, but they cut your hours. So instead of working 40 hours a week, now you work 5. Well, you're not laid off, are you? You're just working less. So you do see junk like that happen. Luckily, we have programs to catch junk like that today. All right. Now, I'm going to go Illinois specific here and then kind of get back to the CARE Act at the end. So if you're not from Illinois, you may want to skip ahead just a little bit, but a lot of these are going to also play into your own home state. So in Illinois, it requires a base period of at least $1,600, so $1,600 in your last 6 months, and it does require $400 minimum in a quarter. So you have to make at least $400 each quarter, $1,600 total. In Illinois, independent contractors do not count for state as they did not pay a premium in. There is an appeal process if the employer challenges, and I'm very curious to see how this works with completely overwhelmed unemployment system employees. How on earth are we going to handle appeal processes? And I don't have an answer for that. We're going to see how that goes. The employer can say, no, they weren't laid off, they quit, and then we have to go through an appeal journey. It's adjudicated by the state. Generally, states are going to require 1 to 2 weeks before you file in hopes that some employees will find work right away and won't wind up having to clog up the system. So if I'm eligible in the state of Illinois, how much do I get? Well, in Illinois, you're going to take your highest base period, either the last 6 months you worked or the previous 6 months before that. You're going to take 47% of that, and then you divide it by 26. And so that comes out to $461 a week as the cap. So let's take me, for example. If I made $100,000 this year, then you would take a $50,000 base period. That's my 6-month income. You multiply it times the law in Illinois, which is 47%. You divide that by 26 weeks, and you can see $903 would be an unadjusted amount. But the state of Illinois isn't going to give me $903 a week. Instead, they're going to limit it to the base cap of $461. So $461 a week is the most anyone in Illinois can get. There are supplements if you have dependent children that'll raise that a little bit. If you're the only one working in your household, another supplement might raise it some. But that's a hard cap. And again, the cap in Alabama is about $280, $260. So caps vary. And this is a little misleading because this is gross income. There's 10% federal income tax withheld and 5% state. So you actually only get 85% of that amount in your account or in a debit card. All right, so that's how much you get, somewhere in the high threes net a week in Illinois. So going back to our systematic problem, 10 million Americans getting $300 a week, walk through that and economic consequences. Evictions like we've never seen before, foreclosures like we've never seen before, people going hungry, bread lines. It would be worse than the Great Depression, and it would be very sudden and very, very, very horrible for the United States to see that happen. Right, in Illinois, you get 26 weeks of benefits, and again, you have to be applying. All right, so let's get back to the idea of this worst case scenario that we're seeing right now. All right, we got 10 million unemployed people. What are we going to limit them to? $300 a week, $200 a week? What on earth is going to happen? And our government understood that. So as part of the CARES Act, the federal stimulus passed in March 27th. Part of the CARES Act said, all right, we know that unemployment is going to be a problem. We hope that it's short term. So we're going to supplement those unemployment benefits by $600 per week in addition to their state benefits through July of 2020. So if you're receiving a state benefit, this will kick on. You'll get your 26 weeks of state plus 26 weeks of federal, and then another 13 weeks of federal after your state evaporates, and that'll be how it works. Now, some states could increase their state if they have the money to do that, but they're probably not going to be able to. So what this does is that it would, in my previous example, for myself, if I were suddenly unemployed, that $461 a week before taxes would be added to $600 a week, and I'd get about $1,000 a week before taxes. Now, with $1,000 a week, I can feed my family, I can pay my mortgage, I can pay my taxes, and what that does is throws me a lifeline for 6 months. Now, the CARES Act is under the impression that this is a temporary issue, and that within 6 months we'll see the economy pick back up again. And if we believe that, then we would say this is probably going to be able to work in this pinch. And it definitely beats not having it. We'll see if we need to pass a second one, if this winds up dragging beyond that time period. But that's really the CARES Act throws a big lifeline to the unemployment system. The CARES Act also deals with this garbage about cutting hours. And it's not always intentional. Sometimes it's by economic necessity. But on occasion, it is intentional. So what happens if you go from 40 to 5 hours a week? Well, if that's the case, yes, you're still employed, but you can enroll in what's called STC. Illinois has one. It's called a short-time compensation plan. The idea here is that if you have reduced hours, you now qualify for this unemployment benefit. So all of a sudden, you can get your $600 a week. You can get some small state benefit too. If your state pays into the program, the federal government's going to help subsidize it. All right, so that's a nice additional perk of the CARES Act, because we have quite a few hospitality industry. They're trying to keep everyone working, but they're just not, the hours aren't there. All right, next up, what do we have? Well, the next element that we have is this expanded eligibility. So previously, before the CARES Act passed, we had, if you were an employee of an employer who paid in, you were eligible for unemployment insurance. But that left a lot of people out in the dark, especially with more and more Americans working as contractors in a gig economy. Now we have expanded eligibility. If you did not qualify as a state employee, but you can show or attest that you are impacted by COVID-19, and there's about 12 questions you go through, and if you answer yes to any one of them, you now qualify not for the state, but for the federal. So this expanded eligibility says, okay, you didn't qualify for the state of Illinois. You get 0 from them, but tell you what, we'll give you $600 a week because you're impacted. This increases the amount of individuals that will be receiving CARE Act benefits. It protects the states that they're not going to pay out who didn't pay in, but it gives you something. You do have to show that you're impacted. Theoretically, you could be audited to that end. But the impacted statements, you're sick with it, a family member's sick with it, it impacted your industry, your business, and if that's the case, yes, you would qualify for relief. It also expanded eligibility groups. If you fall within this group, you do not have to be looking for employment. We don't expect a sick person to look for employment. We don't expect someone taking care of a parent to be looking for employment either. We file in the state we worked in. For Illinois, there's the link. You can Google, of course, what state you work in the unemployment office and file. In Illinois, again, did you earn $1,600 in the last 6 months? If the answer is yes, you can file. If you're temporarily laid off, you can file. If you're not from Illinois and you're watching this, look at your own states for rules on that end and consequence. What if the $600 a week isn't enough? And that's a very fair reality. If you have debt, if you have credit card debt, if you have other debts, if you have high expenses, what can you do? Well, we need to get in front of it from a debt standpoint. Always let a lender, debt collector, landlord know if you're not going to be able to make it and try to work out a payment plan. That's always step number one. Get in front of it. Don't put your head in the sand. That's the worst thing you can do. If it's still not enough, we consider local food banks. We consider churches, community assistance programs. We consider ham sandwich investors. It's one of the neatest idea. I heard this from a webinar the other day. Ham sandwich investor, someone who's always willing to make you a ham sandwich, always willing to let you sleep on their couch in a time of trouble. Now with social distancing, maybe that ham sandwich investor packs it up and gives it to you. But consider those family and friends in tough times. Another element that I'm going to point to is that unemployment insurance is not a crutch. It is not something that exists because you did anything wrong. Unemployment insurance is here for exactly this situation, for systematic risks that rip through our economy and tear it asunder. That is what unemployment insurance is for. There's no shame. There is no dignity lost in filing for this insurance benefit that we're entitled to if our employer paid in and is within the CARES Act, even if we wouldn't normally qualify. If we're fortunate enough to have work, if we're fortunate enough to have a little extra, what should we do? It's time to give back. Food banks are in desperate need. Look at community programs. That spirit of gratitude means that perhaps we can become the ham sandwich investor for those we love, those we care about, and those around us. That we can use the gratitude, use the extra income we have. And right now, giving back to community is more important than it's ever been. And if we have those resources, if we are lucky enough to have an emergency fund, let's make sure that we give to the world around us during this great time of need. Closing thoughts on the CARES Act. The CARES Act has been monumental in making the world a better place for the systematic unemployment we see. It's already going to cost around $230 billion. It will only be more. Every week, as we see more unemployment claims in, that amount will raise. Eventually, we'll probably need another stimulus package just to tackle unemployment benefits. But that $600 a week for people that are unemployed is going to go a really long way to financial health. The fact that it expands to people in the gig economy it traditionally didn't expand to is worth its weight in gold. The closing message, it will be okay. This is a recession. Usually we're looking at around 340 days when the stock market drops by 30% or so before it comes back up. That's a year, but it's just a year. So it's going to be all right. Unemployment is protected. And please, if you are unemployed, if you are impacted, share this with other folks and file. Your employer paid in, and it's a benefit waiting for you. And thank you very much.